Okay, it's time now for On the Radar. We are back with Patrick Horan, principal at Agilith Capital, to tell us why Cineplex is on your radar. Patrick, you say this company's taken on a little too much debt. You think that's a good thing?
Well, it used to
For
be a good thing
investors.
as interest rates were coming down and debt got cheaper. But we've hit an inflection point a few years ago, and debt is getting more expensive, and the carry of debt. So this company trades at about 7.5 times EBITDA, and a lot of that EBITDA is claimed by debt. It's got leverage rates of over 5 times, which is quite high. And they have an issue at the box office where they're just not producing the CGI-based films anymore. And you've got a generational move from one cohort to another that is just watching different kinds of shows, and there's no really impetus anymore to go to the theater and actually watch. So we're short the stock. We think they're going to have a very difficult time paying back all of this debt. We think that the box office has a lot of issues with Netflix, and the studios are challenged right now in terms of producing really big budget films. So we don't like we're short Cineplex, and we would avoid the stock. In fact, we think it's going to go down. We think it could potentially even go into bankruptcy if they don't really hunker down and actually restructure. So we think that's coming. It's probably going to be ugly, and they're going to have to do something about that big debt load.
Okay, next on your radar is a stock where you think increased defense spending will help with this one. Tell us more about Magellan.
Yeah, Magellan. We like Magellan. I've mentioned Magellan probably 3 or 4 times over the past couple of years, and it has been a fantastic performer. I mention it now because there's a nice check back in the stock with this recent move in the markets down. And Magellan, it's not for the faint of heart, but the business model is actually pretty good. They have visibility from they're in defense, they're in the aerospace market. So their visibility between Boeing and Airbus goes out 5 to 7 years. So they have visibility there. Defense contractors, they've got very large contracts with a number of defense contractors that go multi-years past that. So the visibility is excellent. Their margins have just been climbing back from very poor COVID challenge days of supply constraints and labor constraints, and they are one of the champions in Canada of our defense industry. And we all know that we're going to have to spend more in Canada, and hopefully it's going to come from Canadian-based companies. I think that's what our government wants to do. So we think Magellan's a big benefactor of that. So between visibility, not a demanding stock, check back, we think it's a buy here.
And lastly, on your radar is Canadian software as a whole. Like, you think Canadian software is potentially likely to fall?
Yes. Yeah. This has been, a wonderful performer over the past decade. We were actually long many of these stocks, going back 10, 15 years ago. We haven't been long. We've ignored them. But yeah, even better, we're actually short the sector. There's probably 6 Canadian software stocks that we're short right now. And we think that there's a big question in terms of their business model. What do they stand for? They have had massive margins in terms of what they get. They've been able to build upon it. And this is a typical cycle where you get companies that really outgrow and take advantage of their leverage, and then they're susceptible to a change in technology where someone from nowhere that is really hungry and is a disruptor comes and starts to eat their margin. And AI is that thing that's happening right now to software. So I would stay away from all software. I don't think this is just today, this week. this month. I think it's a year from now, 2 years from now. I lived through the dot-com. I saw how it behaves. It's probably 5 years before these guys figure out their new business model. And everyone's going to point to the old business model and how it's growing, but that the revenue growth is going to stop. The margins are going to start to compress. The free cash flow is not going to be there, and then they've got to diversify and figure it out. So I think there's a massive consolidation period that will happen over the next 5 years. It's not going to be leadership anymore. So anyway, stay away from software, especially Canadian software included, and that's where we are short.